Welcome to my new video. Today we will talk more about economy.
Whether the probability of a recession is rising, and if so, how likely is it, and what are you going to be watching?
Well, I think the probability of a recession is very real in the next year. We put it at about a 20% probability. So it's certainly not a zero probability.
This isn't just a dip. This is a reset. Welcome to the 2025 recession, a story of inflation hangovers, geopolitical chaos, a shifting job market, and a reality check for the global economy. In this video, we'll break it all down. What caused it, who's hurting the most, what sectors are surprisingly thriving, and what this all means for you. Stay with me. The full picture is more than just headlines. To understand the 2025 recession, we have to rewind not just to 2024, but to the COVID-19 pandemic and everything that followed. After massive stimulus packages in 2020 and 2021, the world faced the inevitable: inflation. Central banks, and especially the Federal Reserve, responded by raising interest rates aggressively starting in 2022. While inflation began cooling by late 2023, the side effects were already baked in. By early 2024, interest rates were at their highest levels in over 2 decades. Mortgage rates in the U.S. topped 7%. Credit card debt hit record highs, surpassing $1.1 trillion by late 2024, with delinquencies rising sharply. Businesses, especially small and medium enterprises, struggled to secure loans. Venture capital dried up, and tech, once the darling of the post-pandemic boom, began a wave of layoffs. Meta, Amazon, Google, and others trimmed their workforces significantly. Then came the global slowdowns. Germany, long considered the powerhouse of Europe, entered a technical recession. China's property crisis deepened, and with ongoing conflicts in Ukraine and the Middle East disrupting supply chains and oil prices, the economic engine of the world started sputtering. The recession of 2025 isn't a sharp crash. It's what economists are calling a slow burn recession. But this isn't 2008. There hasn't been a massive financial collapse. Instead, this is a confidence recession. Consumer spending has weakened. High interest rates have squeezed households. And despite record low unemployment in 2023, job growth has stalled in sectors like tech, real estate, and manufacturing. According to the Bureau of Labor Statistics, job openings fell below 8 million for the first time since 2021. Meanwhile, productivity is flatlining. And while inflation is no longer the main villain, the cost of living, from housing to food, remains historically high, especially in cities like San Francisco, New York, and Toronto. Globally, the IMF has downgraded its 2025 world growth forecast to 2.4%. Dangerously close to what economists consider recessionary territory for the planet. So who's getting hit the hardest? First, the middle class. Home affordability is at a 30-year low. Millennials and Gen Z, already burdened with student debt, are now facing stagnant wages and fewer job opportunities. Credit card defaults are rising most sharply among borrowers under 35. Small businesses are suffering too. Higher borrowing costs mean expansions are delayed or canceled altogether. Retailers are seeing lower foot traffic, and e-commerce sales have cooled off after the pandemic surge. On the corporate side, commercial real estate is a ticking time bomb. Office vacancies in cities like San Francisco, Chicago, and London have reached historic highs. Some buildings are now worth less than their outstanding mortgages, but not every sector is losing. Energy stocks, especially oil and gas, are up, thanks to continued geopolitical instability and OPEC+ production cuts. Defense contractors are thriving due to rising global tensions, and surprisingly, AI and automation companies are rebounding as businesses invest in cost-cutting technologies to weather the slowdown. Even gold and cryptocurrency have seen a modest resurgence as investors look for safe havens in uncertain times. Perhaps the most overlooked part of this recession is its psychological impact. After years of volatility, from a pandemic to inflation to wars, people are tired. Confidence in institutions is low. A recent Gallup poll showed only 22% of Americans feel optimistic about the economy's direction, the lowest since 2011. Young people are delaying major life milestones: marriage, buying a home, having children. Many are questioning whether the system still works for them. Meanwhile, older generations are watching their retirement funds take a hit. Again, and with healthcare costs still rising, many are being forced to work longer than planned. In short, this isn't just a recession of dollars, it's a recession of trust, of security, and of dreams deferred. So where do we go from here? The good news? Every recession ends, and this one, while painful, is also recalibrating parts of the economy that were unsustainable. Housing prices are correcting, tech is becoming leaner, consumers are being more intentional. The Federal Reserve has hinted at potential rate cuts by late 2025, though they remain cautious. Inflation is mostly under control, which opens the door for monetary easing. There's also a silver lining in resilience. Startups focused on climate, AI, and infrastructure are gaining traction. Governments are investing in green energy and semiconductor manufacturing, strategic sectors with long-term potential. For individuals, now is the time to reevaluate. Are your finances recession-proof? Are your skills aligned with the jobs of the future? Are you preparing not just to survive, but to adapt? Because one thing's clear, the old normal is gone, and the next chapter belongs to those who are ready for change.
Historically, the Fed is willing to tolerate above target inflation for some time. In fact, if we go back to the post-COVID environment.
Thanks for watching. If you found this video helpful, make sure to like, subscribe, and share it with someone who needs to hear this today. Drop a comment below. How are you navigating the 2025 recession? I'll be reading and responding.